Now it is time to take a look at all the different things that affect stock prices. What happens out there in the real world, in the economy, in business, in politics, has a major effect. But the trick is to figure out whether a given event will push prices up or down. And that takes us to the first type of market analysis, fundamentals. Now, the first thing you got to know, although this should come as no surprise, is that the market moves in cycles or in trends. And when we talk about trends, I am not talking about this. News events can send a market up or down for a day or for a week, but then things go right back to where they were. I am talking about major trends, the bull and the bear markets. These are the most important events on Wall Street. I want you to take a look at this chart. It's of stock prices going back to the turn of the century. And you can see major market upswings and declines. And the drops like this one over here, this is the Great Depression of 1929, the crash. This is called a bear market, called bear because the stock market is believed, like a bear in hibernation, to be going to sleep. And this is indeed a very big sleep. But now look what happens after World War II. It just creeps up, 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 up before leveling off in the 70s. This is a long upturn. This is called a bull market, called bull because the market, we like to think, is roaring or charging like a bull. Now, what makes the market go up or down is you, buyers and sellers. The stock market has a slogan where thousands vote every day, and that is exactly what happens. The exchange doesn't set the prices, you do. Thousands of investors voice their opinions with cash. Now, this is a buy order. So if on any particular day the pressure is heavy on the buy side, then prices will gradually go up. On the other hand, if the business of the day is heavy selling, these are lots of sell orders, then stock prices go down. Now, obviously, like all investors, what you want to do is buy when prices are low and sell when they're high. I mean, wouldn't you love it if you had bought down here at the bottom and sold somewhere up here on top? But to predict those magical moments, you've got to know where you are in a major trend, and you've got to guess which way the market's headed in the near future. And that is where fundamental analysis can help. A fundamentalist guesses where the market is going by tracking economic signals. Now, as a rule, when the economy is doing well, stocks do well. Although the stock market tends to run a little ahead, you may see the market turn up or turn down before you see a similar move in the economy. And that's because investors have already guessed what's going to happen, so they've already jumped in or jumped out early. Now, how do you make early guesses like that? Well, here are some fundamental signs that I think you should consider. Let's take a look. Production figures are important. And look for housing starts. People start building when the economy is improving. Keep an eye out for automobile production. It is very responsive to the economy and has a big effect on the market. Steel and crude oil production are also important business indicators, and you can also get monthly figures on factory use statistics and total manufacturing and mining production. All these figures are widely reported. Watch for them. They're on the financial pages, sometimes on the front page. A second important fundamental is money. How much is out there and who's got it? Business loans are important. They're reported every week. This is a sensitive signal because when businesses start to borrow, that usually means they're ready to expand or build up inventories. You should also watch the nation's money supply. It affects interest rates and inflation, which one way or another is going to end up influencing the stock market. The third important fundamental is sales. Retail sales are a good indicator of how consumers feel about the economy. When things look better, people spend more. It's a bad sign if they start spending less. Home purchases, auto sales, also important. All these sales figures are widely reported in newspapers, in every business magazine, and on television. Now, for the big picture. Watch the index of leading economic indicators. This monthly index takes a dozen key economic trends, housing starts, stock prices, money supply, new orders, interest rates, and it puts them all together, and this is one of the most useful forecasting tools available. Generally, it anticipates events in the economy by a couple of months. It'll rise just a few months before the economy rises, and it'll drop just before the economy slows. You'll find this index looking very much this way in the newspaper every month. All right, now these fundamentals are an early warning system, and I want you to keep this in mind when you use them. Because sometimes you'll be watching a major market trend that's kind of going along in one direction, and you'll notice that some of the indicators, like housing starts, money supply, the index, turn in the opposite direction. Watch out. This can't last. Something's got to give, and it's going to be the stock market. The stock market eventually falls in line with business activity. The market can't keep going up if business is falling off badly, and it won't stay down if business is going up. So when you see the indicators diverge from the market, you've got some decisions to make. It may be time to buy or sell. And also remember, keep an eye on the world outside.
Stock market prices are ultimately decided by A, news events, B, bull or bear markets, C, Congress, D, individual buyers and sellers. D is the answer. Individual buyers and sellers always determine the prices. The index of leading economic indicators is A, compiled by the government, B, found every month in newspapers, C, consists of 12 key economic indicators, D, all of the above. The answer is D, all of the above. If the market has been heading up for some time and business indicators start to decline, you can expect a continued bull market. True or false? False. The market tends to fall in line with business and will probably head down if business continues to decline.